Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you as always from the CNBC-TV18 Motilal Oswal studios. Thursday morning, markets looking good so far this week. Let's hope for more. I'm Prashant. With me, my colleague Surabhi and Mangalam. Guys, hi, good morning.
Hi, morning both of you. And the Fed sang a song that the markets rather liked. They managed to do that fine balancing act, not scare people too much, give enough reassurance. So it was all good on Wall Street as well.
It was all good on Wall Street, likely to be all good on D Street, and started with small wins, and now everyone's looking for the bigger wins in our market itself. The way the mid-cap index moved yesterday, can we have an encore today or not is something that the bulls will ask.
I mean, bombed out names are coming up. Outperformers are starting to participate as well. Market breadth is looking good. So it's broadening out, and I think that's a very, very good thing. It's not it's not narrow. It's broadening out. Well, I'll just quickly run you through things you need to sort of be watchful of right from the top. And of course, we have to start with the Fed, where you basically had the no change as expected, nothing at all. So it was all status quo. But the projections is what I want to start with. Those seem to have moved in a stagflationary way, stagflationary direction. Now, why am I saying that? Growth estimates have been brought lower. Unemployment rate is higher, whereas inflation expectation has moved higher. This is the dot plot of the Fed, the projections which I'm talking about. So, growth lower, inflation higher, and I think that's the reason why we are picking on this. But otherwise, I mean, the press conference and Fed Chair Powell, he kind of said, stagflation did not come up, but he said, well, recession risks were not high. We can move the graphics along. He left the median dot in terms of rate cuts expected for 2025 at 50 basis points. As a consequence of it, market expectation, the market pricing is now 66 basis points for 2025. He also kind of said, well, we'll have to see. A lot of it was around tariffs and trade policy as far as the U.S. is concerned. So he said, well, we will present a revised update on their expectations of what the tariff policy, trade policy will do to the U.S. economy, etc. But we are not in a hurry to respond to the effects of the trade policy. So I think it's wait and see largely. I mean, the dot plot, etc., is attracting a lot of attention. But if you really wanted to take away something, I mean, there's not very much. It's the driver is the trade policy and what happens on the 2nd of April. And I'll get to that in just a bit. Now, U.S. equities ended higher. The S&P was up 1%. NASDAQ was up 1.5%. 10-year yield was down 4. Dollar index about 103.4. Nothing very much. Slight move up on the dollar index. And this is the other important bit last night. So the U.S. Treasury Secretary, in an interview to Fox Business, the news network there, essentially said, and this is something we've spoken about in the last 2 days, right? Into the 2nd of April, how will tariffs be delivered? Will they come up and say, well, we're imposing reciprocal tariffs, so this, and this is it? And then we'll see. Well, the delivery mechanism is important for the market, and Scott Bessent, the Treasury Secretary, who himself is a market man, who Ed Yardeni 2 days back told us that the markets thought Bessent was one of us, that is one of Wall Street. Well, maybe not so. But Bessent last night said that the tariff delivery is unlikely to be big bang. What he said is, and that quote said it, he said, well, on the 2nd of April, after all the assessment, etc., we're going to provide every country, our trade partners, big trade partners, a number. And that's the number which is the cost of doing business in terms of trade barriers, which those countries impose for U.S. goods. And of course, we will kind of reciprocate. It looks like it's a process, it's a negotiation. It's not slam dunk on April 2nd and be done with it, which to my mind is at the margin positive. It's not, it's erratic, and erratic is in this case good. And it's not, we're done with it and deal with it. So I think this is the reason why I'm saying maybe at the margin interesting and important as well, and maybe positive. But of course, we don't know enough. This is all kind of looking ahead, looking into the future and trying to interpret what Bessent really said. Now, that brings us to the market here, which has been trading very well. That's the India market. Gains are broadening out, as I said, and mid-caps, small-caps, etc. doing very well. Capital markets, real estate, defense yesterday participated. For the Nifty, we need to cross the 40-day exponential moving average. We, by the way, closed above the 40-day yesterday, but only marginally, about 30-point beat on the 40-day. So that's the first level we got to stay above, which is 22,884. After that, the next resistance stands at 23,050. It's a range, actually. I've kind of put the median number there. But 23,050 is the next resistance on the upside. Support comes in at 22,660, which is the hourly average for the Nifty, the 40-hourly exponential moving average. The Bank Nifty saw follow-up gains after crossing the 40-day exponential as well. Resistance here comes in at 50,287 and then 51,085. These are nothing but the 38 and 50% retracement of the entire decline which the Nifty Bank has seen, and support stand at 48,863. Gift Nifty will come up on your screen, gives you a sense of how we likely to start. Another century will fingers crossed. And of course, you know, we've been seeing that gains are being built on. It's not as if you start higher and then gains get fizzled out, which was the case till about a week and a half out back. And the hope is we kind of build on and move ahead. So 23,081 on the Gift Nifty. Surbhi.
Well, absolutely. For me, this has been one of the most uneventful Fed meetings in a long time. And from a market move point of view, or even a commentary or headline point of view, nothing out of the ordinary. And maybe the market wanted exactly that. It seems that the U.S. Federal Reserve is more of a market's friend these days than the U.S. president, contrary to what was believed earlier. But anyway, what we have right now is a very mixed Asian picture. Even though Wall Street had that very solid close because the Fed is indicating that you'll still get at least 2 rate cuts this year, which was quite reassuring. By the way, in terms of central bank action, China has left its benchmark rates unchanged again this morning. The 1-year and the 5-year loan prime rate, as they call it, it's reset every month. No changes this time around, so they've been holding steady. The 1-year rate is at 3.1%. The 5-year loan prime rate, which is what is the basis for setting mortgages in China, that's at 3.6%. So no changes by the Bank of Japan, nothing from the Fed, nothing from the Chinese central bank this morning. Absolutely steady. The Japanese markets, by the way, are shut today for local holidays, so just keep that in mind. The others, the picture is mixed. If I'm looking at the Chinese markets right now, mainland China and Hong Kong, there's some red out there. I'll get to Brent in just a bit, but first the Asian screens are very mixed. That's the short point. Singapore's higher, but some of the other regional markets are a little weak. Now, oil is a bit of a worry, you could say. The oil markets seem to be latching on to the commentary around economic uncertainty in the Fed statement, while the equity markets continue to rally. So there's 71.14 on Brent right now, and that's an increase from where we were, last week, sub $70 a barrel. So watch out for this. But aside of this, not too much, to worry about here for us in India. The Nifty's had a nice, rally from the lows. We're talking 3.7% at the index level. This is as per the closing. The lowest point we hit was on the 4th of March. That was a closing low of 22,082. And from there, it's been a nice resurgence. And financials have been leading this leg, especially in the last 5 days. When you look at the Bank Nifty, look at the Nifty. About 2% of the Nifty. Bank Nifty has done much better. If you look at the broader financial space, including areas like insurance, etc., that's where the action has been, and that's where it could likely continue. On the fund flow side, well, there's a bit of a negative number to report today. After yesterday's positive number, if you're thinking there's more immediate one-sided buying coming in, that's not the case. About 1,100 crores of selling in the cash market yesterday. Domestic institutions are buyers, so no problems there. Over 2,100 crores of FPI buying. But I guess the short point is the momentum seems to be coming back in the market. The Fed hasn't spoiled the party, so maybe we can see a little more of the green today.
Little more of the green, and the Gift Nifty is indicating a 100-point green. So let's see, whether we sustain above that 23,000 mark or not. And yesterday we thought that there could be a bit of a pause for the breath on the frontline indices, even as the mid-caps are doing better. Today, the sense that one gets is that maybe the rally on the frontline indices continues as well. And I'd say why? Because, yesterday we paused for breath. Today is the Nifty weekly options expiry. And with all things said and done on the Fed itself, the dollar index has maintained. So we have the dollar index, which has cooled off to around 103.36 after the Fed meet. There is the Nifty weekly options expiry today. And yesterday, the worry was the put-call ratio is overheating at around 1.3. It's cooled off mildly to 1.2. Still not out of the woods, but it has cooled off. The Nifty Bank, which has been leading the rally, has crossed the 20-day moving average and the 50-day moving average. The Nifty still has some work to do above the 50-day moving average. So it's crossed the 20-day moving average. Gift Nifty indicates that the 50-day moving average will be crossed at the open itself. Whether it sustains above that or not rests on what the IT index does. Yes, we've seen the IT index decline and underperform, but could we see some brighter prospects today because of the Fed meet outcome and the Nasdaq move that we've seen over a few trading sessions? That's something that we'll have the answer to. momentum in the mid-caps may continue. That is something that we can say with reasonable certainty. Yes, the FI sold in the cash market, but the interesting part is that over the last 4 trading sessions, the net flows by the institutions have been positive, over 1,000 crores. And that's a lot bigger than what we've seen in the previous 4 trading sessions, where there was a net outflow in the cash market as well. Add to that, the FII purchase in index futures continues. 2,000 crore worth purchase yesterday, 9,000 long contracts added, 3,500 short contracts covered. In the last 3 sessions itself, FIIs have added nearly 20,000 long contracts and covered 37,000 short contracts. So as a result of which, the FI long exposure just in last 5 sessions has moved from 18% to 27%. And why is this number important? Because this is the highest long exposure that we've seen by FIs in index futures since December 23rd, 2024. So highest long exposure in this calendar year itself. Now, ahead of weekly options expiry, the first thing we'll be watching out for is the 23,000 call. Premium of 50 rupees, 1.2 crore open interest. Will they run for cover today or not? And if they do, there is a chance of a melt up. Why do I say that? Because the 23,300 call buyers have taken a lot of punts at just about 3 rupees per pop. At the lower level, there is strong support coming in at 22,750. That's what the options are indicating. 2 stocks I'm watching out for. We pointed out the possibility of Manappuram and BSE exiting FNO ban. That's exactly what has happened. BSE is up 6%. Manappuram, ahead of that board meeting of fundraise today, will be in focus.
Okay, a possible melt up. Interesting. Let's see if the short covering can actually lead to that. It is Thursday, so anything's possible. Well, let's start with the equity call of the morning. On equities, Surendra Goyal of Citi reiterates their constructive stance on Indian equities, given stable and improving macros significantly. Domestic-oriented economy, markets, and more reasonable valuations on absolute and relative basis post a 13% correction from highs. He says they have upgraded NBFCs to overweight, downgraded staples to underweight versus neutral earlier, and they've added Chola, Zomato, removed HUL from their top picks.
William Lee is with us now, Chief Economist and Executive Director at the Milken Institute. William, good morning. Great to have you with us here. Prashant on this side. The Fed will come too, but Scott Bessent remarks to a television news network yesterday that we'll provide our trade partners with a number, which is the cost we estimate is the cost of doing business with you. How should we read it? It doesn't look like maybe it's big bang, but then there is room for negotiation. At least that's what I thought. What do you think, William?
It sounds to me like the Trump administration is opening salvo toward what they're trying to do by April, which is to try to establish a world trade framework where we can level the playing field. The notion of reciprocal tariffs does not mean that we're raising our tariffs. It means we're raising our tariffs up to where our counterparties, our trading partners, have their tariffs. So if between now and then our trading partners decide that market access to the United States consumer and United States marketplace is so important, they may actually lower their tariffs so that we will lower our tariffs. So right now, there's a tremendous amount of uncertainty because the state of play is in flux. And Chairman Powell today emphasized that over and over again. The uncertainty is where the level playing field will wind up after the opening rounds. And right now, I think Scott Bessent has given you the opening round for the United States.
Sure, absolutely. The opening round will be that number, and then let's see how those negotiations progress from there. William, thanks so much for joining us today. Now, I mean, what about the Fed's assessment? What do you think of it? Because at least yesterday, the Fed didn't seem as worried and concerned about recession, etc. In fact, the chairman alluded to some of those forecasts. He said that forecasts outside the Fed are pointing out to the higher probability of the recession, but we don't think so right now. What are you expecting in terms of further policy moves?
At the beginning of my professional life, I was a forecaster at the Fed. And I have to say, the state of art of forecasting really hasn't progressed much since then. And I think it's gotten worse because the media is starting to hype up a lot of the incoming data as if everything were the same. Soft data, hard data. And one of the things you'll learn as a forecaster is that soft data is exactly that. Very, very soft, very, very unreliable, especially confidence surveys. And that is where I think a lot of the press is getting its ammunition about, oh my God, the consumer is feeling awful about their state of life. Their confidence is down, and the retail sales have started to slow down. So clearly, we're on the verge of a recession. That conclusion is so incredibly absurd. I have a hard time understanding how professionals can stop from laughing. The consumer confidence surveys have always had several flaws about it. The Michigan survey is highly correlated with the stock market. When the stock market goes down, a lot of people in the Michigan survey respond badly. The Conference Board survey is highly correlated with the state of the job market, in particular, how easy it is to get jobs. And right now, there are a lot of job openings, but there are fewer and fewer hires. So there again, another explanation for why it is that consumer surveys have gone down. As Chair Powell said, it's really hard to tell what consumers say and correlate that to what they actually do. People say they feel awful, they think the world is coming apart, and they go out and buy a new car.
That's fantastic insight, William. And you've been a man on the inside, like you pointed out earlier in your career, so you would know. But then to sort of come back to that question, you don't seem too worried about the state of the U.S. economy in that case, just like the Fed. So what are we talking about over here? I mean, the economy chugs along, we get 2 cuts, and all remains well?
There is without a slowdown in the U.S. economy because it was growing at a very unsustainable pace, well above 2.5%. And coming down to closer to 2% is where the natural rate of growth is. And that's exactly where I and the rest of FOMC is anticipating the economy will glide into toward the end of this year. And the fact that the consumer is slowing down is a good thing, because one of the huge vulnerabilities in the U.S. economy that's not covered enough, which I have mentioned on this show in the past, is that U.S. consumers are consuming as much as they are. In fact, they're consuming at a pace that's well above the pace of income growth, because those consumers that have assets, that own stocks and pension assets, which is only about, by the way, 20% of the population, those consumers are accounting for 80% of the growth of consumption. And so long as they can cash in their capital gains, they're doing quite well. But as you noticed, the stock market has gone down, and those people with the risky portfolios in NVIDIA, Tesla, and Magnificent Seven are not feeling like they have that many capital gains to cash in anymore. So those consumers are clearly slowing down. The other 60% of the U.S. population has really been living paycheck to paycheck, hand to mouth. Many of them have had to get second and third jobs just to make ends meet. That was the basis of the huge amount of people voting for Trump, because they felt that they needed someone to change things around so that their ability to make a decent wage will get better. So the consumer slowing down is a good thing, is an expected thing, and is a very dangerous thing in the sense that it's something to watch out for, because once the people with assets run out of savings, that's when we start to run out of steam for the consumer. And the key is whether investment will pick up or not. And that depends upon the rest of the Trump policies, reducing the size of government, reducing corporate tax rates, encouraging foreign investments in the United States.
William, we'll leave it there. Great conversation as always. Thank you very much, and look forward to our next one. Appreciate it here on CNBC-TV18. Well, there's some punchy comments coming in from William, and I think absolutely makes sense. One feeds off the other. Surveys feeds off the market feeds off the survey, so chicken and egg in that sense. But well, let's quickly run you through the corporate interactions lined up here on the program. 8:35, Deepan Mehta of Elixir Equities joins in with some fundamental stock conversation. We'll have at 9 o'clock, we'll have Kumar Rakesh of BNP Paribas talk to us about the key trends in the IT space. 9:20, Vineet Sambre, DSP Mutual Fund. He's a market master. 9:30 a.m. The management of CAMS will be with us. They've signed with the insurance repository agreement with LIC. Arnab Banerjee of CET will be speaking with us on the quarter gone by and the outlook. 9:50, Ravi Kapoor of PwC India and Sachin Dikshit of JM Financial Institutional Securities will join us on the rise of the quick commerce and its impact on traditional retailers, retail outlets actually, retail chains. And of course, towards the end of the show, Lata will be speaking on the economy, Asia macros, markets post the Fed decision, with a guest from S&P Global Ratings, the needed state of BlackRock. That's the lineup.
Right, with that, we'll step into a short break. But as we do that, let's give you some stock-specific action to track today as well, which we will get to in just a bit in our special Top 10 segment. But to just give you a preview, Voltas, Manappuram Finance, Jyoti Structures, NCC, Indian Bank, Anthony Waste and International Gemological Institute stocks on our radar on the back of positive news flow. Paytm, Indian Overseas Bank and SBFC Finance are stocks on our radar that are likely to open in the red on account of the news flow.
Welcome back. So we are prepping for a good start. Let's get the implied open back up on the screen. It's choosing to be on the green side, though Asia's a little mixed, but yeah, there we go. Another 90 points higher. That's what the indication is. So let's see. It's bulls in total control. Our team is standing by with the CNBC-TV18 list of top stocks to watch. So let's get started with IOB. Guys, morning to all of you. Sudarshan, why are you watching out for this one?
Morning, Surbi. So IOB yesterday has disclosed to exchanges that it has launched QIP, and for that floor price, that company has fixed floor prices normally as per the SEBI formula. So it is 42.70 per share, and total size of the QIP is of up to 2,000 crore rupees. And of this, base size is rupees 1,000 crore, and upsize option is of rupees 1,000 crore. And deal size is of up to 49.3 crore shares, forming 2.6% equity. Now, the important part is indicative price, which is 40.5 cents per share, more than 7% discount to yesterday's closing price. That's the reason I'm going with red, because discount level is very high for the QIP that IOB has launched.
All right, Masood, thank you very much for that. So once again, I mean, a QIP secondary market transaction starting to open up as the market is looking a little better. Well, let's talk about Paytm. The stock, of course, has been performing for the last 2 days. Day before was the big move. Yesterday, the stock ended about 3% higher. Vinny is here with more. Vinny, morning.
Hi, morning. So today maybe we could see some bit of a red coming in on the screen. Yesterday the cabinet actually approved some extension of incentives for UPI transactions of up to 2,000 rupees. This is specifically for those small merchants bankers from 1st of April 2025. Now, Jefferies has come out with a note. They've given a whole rating target price of 850 rupees per Paytm. Now, what's the concern is that the incentives are half of the incentives, the value is half of that was of what was given last year. This time it's 1,500 crore rupees. What this means is that incentives now will fall. The benefit that the companies would get would fall from 20 basis point to just 6 basis point. And specifically for Paytm, if this is actually the figure that works out from 20 to 6 basis point as a benefit, then the adjusted EBITDA also could be 50% below estimates in FY25. In FY26 and 27, it would be lower by around 20 to 30%. This is the adjusted EBITDA I'm talking about. And profit before tax for FY25 would be lower and could be lower by 15%. Only one positive sign that we could watch out for, there were news flows coming in around MDR-based charges, that is merchant discount rate charges, which are currently not there for these bankers, Paytm currently. If that starts getting implied, then that could be a silver lining for Paytm. But as of now, red is what we could expect on the screen.
Right, red on Paytm. Let's see what happens on that one, Vinny. But Voltas is a stock that I'm watching out for. Yesterday, we had that conversation with Blue Star and PG Electroplast. Voltas held its analyst meet as well. The stock has been doing well. Over the last 1 month, is up 16% in a wobbly market, increased its gains. The key takeaway from the analyst meet is that the company will focus on profit expansion through value engineering versus a price hike. In fact, over the last 8 to 10 months, the air conditioning market has grown 30%, whereas company has grown upwards of 35%. So they've gained market share and they expect to continue to do that. Yes, production costs have gone up due to INR depreciation and rise in commodity prices. But the company on its part has not taken any meaningful price hikes. In fact, the industry has taken a price hike of 3 to 5%. Voltas hasn't. They've indicated that secondary sales ahead of the peak summer season on a very high base are fairly encouraging as well. And they continue to expect to grow ahead of the industry. Analysts are mixed on this one because Nomura has said they're neutral. We have CLSA, which has said after this outperformance, maybe they have a target price of 1375. Morgan Stanley still maintains its overweight rating. My sense is that because of the fact that the company intends to continue to gain market share and peak summer sales season being more encouraging, the stock, despite the outperformance, may continue to see some green.
Okay, all right. So Voltas is going to be on our radar as well. Let's go back to Sudarshan. Manappuram, today they're looking to raise some money. There's a board meeting today, Sudarshan.
So Manappuram stock has been in focus over the last few sessions. You would have seen that stock has been moving higher despite the stock was in F&O band. It's up 6% this month, up 14% in 2025, and nearly 7% away from the record high. Earlier this week, Manappuram had disclosed to exchange that board will be meeting to consider fundraising proposals, and that board meeting is going to happen today, and board will be considering raising fund via both equity and debt. So what were the reports? Reports were that Bain Capital is likely going to acquire majority stake in the company, and the deal value was seen around $1 billion. On that report, company had clarified to exchanges on February 24, saying that it continues to evaluate proposals as it comes. So on the back of this and ahead of the board meet, I'm going with green for Manappuram Finance because it's important news, and also the stock has come out of the band today.
All right, that's Manappuram, and expectations that we'll see the price and of course open offer, etc. I think all those things will be in focus. But stock's done well coming into this event over the last couple of weeks now. SBFC Finance is the next one we want to talk about. Vinny is here with details. Vinny.
Hi, morning. So SBFC, we are keeping an eye on this one. Now, the promoters, that is SBFC Holding Pte, has sold some stake in SBFC yesterday. This was through an open market transaction. It came in the bulk deal. 1.3% stake is what they've sold. That is around 1.36 crore shares. Value is around 112 crore rupees. SBFC Holdings and the promoter company will be holding around 53.49% stake in the company after the stake sale. But what is interesting is that over the last few quarters also, they promoters have been reducing stake few percentage point, but they have been reducing. In March 2024, it was around 60%. Now, currently, obviously, after the stake sale, it will be at around 53.5%. So, interesting to watch out for SBFC Finance, and we're expecting red on the screen today.
Right, Vinny, thanks a lot for that. I'm looking at International Gemological Institute, IGI. Remember, the stock has been beaten out of shape. It's down 50% from its post-listing high, way below its IPO issue price at 417 as well. And the company's been meeting analysts over the last couple of trading sessions or couple of days itself. What they've said is that the demand for certified diamonds, gemstones and jewelry is expanding beyond traditional market. That was one of the key concerns, whether there is enough demand for, certification itself or not. And on the supply side, the market has a very high entry barrier. Beyond diamonds, they are saying the market is also witnessing a greater interest in colored stones and contemporary jewelry style certification. And the acquisition of Belgium and Netherlands business would give them about 25% additional revenue. They have 65% of the global market share of lab-grown certification as well, which will increase in penetration. So they, on their part, are, assuring the street that maybe the demand for certification will continue. The stock has seen a correction, so maybe opens in mild green. Thereafter, what really happens is what the expectations of the investors are on the overall demand itself for certification. So we'll keep an eye out on that one.
Okay, let's see if that, commentary can add to confidence in any way after the big fall that the stock has seen. Let's move on. There are a couple of other stocks also in news as well. Vivek is rounding them for us. Vivek, good morning.
Well, good morning. Quite a few stocks in focus. This is on the back of news flow. First on the list is Jyoti Structures. The company has given a year-end order book update. So the company currently sitting at an order book of over 1,800 crores. They say that the majority of the orders will be executed in the next 12 to 18 months. NCC, a good material order coming in for this particular company. The company has received an order from the Andhra Pradesh Capital Region Development Authority. The order size is close to 2,130 crore. And the order is for construction of roads as well as other allied activities. Now, the construction period of this particular order is 3 years. Just to give some perspective, at the end of Q3, remember the company received orders of close to 14,000 crore in YTD FY25, and the company had earlier given an order inflow guidance of close to 20,000 crore. So, company closer to its guided target. Now, the other stock on the radar is Indian Bank. The company today will be meeting. The board meeting is held to consider a proposal regarding fundraising. And lastly, keep an eye out for Antony Waste as well. Some relief coming in. The Bombay High Court has dismissed the Navi Mumbai Municipal Corporation's plea to set aside an arbitral award that was awarded towards or in favor of Antony Waste. Now, NMMC has gone ahead and deposited close to 20 crore rupees. This also includes the interest of the earlier arbitral award. So, some green expected on Antony Waste as well.
Okay, all right, got it. Thanks very much, Vivek, for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow around them are Voltas, Manappuram Finance, Jyoti Structures, NCC, Indian Bank, Antony Waste and IGI. The ones that have negative news around them are Paytm, Indian Overseas Bank and SBFC Finance. Okay, let's move on and talk about Ola as well. Ola Electric has now faced a fresh set of issues with the Ministry of Heavy Industry seeking details on sales data and some inspections as well. We have Parikshit joining in with more details. What's the latest, Parikshit?
Well, Ola seems to be facing questions at multiple levels. One, at the central level, the Ministry of Heavy Industries, which is the nodal body for PLI and also the PM drive incentives, is now looking at the mismatch in data. That is what Ola Electric is claiming as 25,000 vehicles sold in the month of February versus 8,600 odd vehicles which are registered in the Vahan or the Ministry of Road Transport Highways registration portal. So they're seeking details from the company as to why there is a mismatch. Secondly, we have seen an order of the Maharashtra government and also by other RTOs in the country. There are inspections happening against Ola Electric at their stores across the country. In fact, in Maharashtra, over the last 2 days, there have been 36 locations where there have been inspections. And this has happened in Pune, this has happened in Mumbai, and close to 34 to 36 scooters have been seized also by the RTO. This is because the scooters are found without valid registration documents and these stores do not have valid trade certificates. A similar a probe inspection has happened in Jabalpur, where 6 or 7 scooters were inspected and a reply from Ola has been sought. We've also got to know that Ola Electric stores in Punjab were also shut down for not having valid fire certificates and trade certificates. We have sent detailed queries to Ola Electric on all of these issues. We are yet to get a formal reply from them.
All right, Parichay, thanks a lot for that. Ola, the news flow continues on a regular basis on that one. We'll keep an eye out on how that performs in trade today. But for all the roundup of the commodity market action overnight, Manisha joins in. Manisha, let me hazard a guess. Gold continues to glitter and yet another record high is what we saw there.
Oh, well, absolutely. And it's not even tiring at these levels. You know, the gold is trading at above $3,050 an ounce right now. This is after the U.S. Fed stayed put on rates as widely expected and indicating reducing borrowing costs by 0.5 percentage point by the end of this year. So the bull market is surging strongly, holding above 3,000, holding 3,050 as well. The geopolitical tension seems to be coming back and the fears of recession also are on the higher side. So there is one safe haven and you have to be invested, whatever size of your portfolio, within gold. But let me remind you, it's not just gold. Take a look at copper prices. 10-month highs onto this one. Inventories have continued to decline. Potential tariff concerns keeping this commodity also on the higher side. And very strong gains is what we are also working with in sense of aluminum and zinc because of supply disruptions. And again, as markets weave in the tariff percentages into this as well, all of these commodities in Asia are trading very, very strong right now.
Manisha, thank you very much for that. Thank you very much for taking us through all of that. We'll take a quick commercial break. Deepan Mehta of Elixir Equities is going to be with us in just a bit from now. We'll talk about individual names that Deepan is watching. We've had a nice rebound. Deepan, of course, has also been turning constructive for the last couple of occasions that we've had him. So that's coming up.
Welcome back. Let's welcome Deepan Mehta of Elixir Equities on the show right now. 102 points is what the GIFT Nifty is indicating as an implied move. Deepan, you know, yesterday we got the news from the DGTR where there are some safeguard duties coming in on flat steel products. Now, whether that does a lot or not is still, out in the open. Analysts expect about 10% increase in EBITDA, etc. But from the decline that we've seen from the highs in the metal prices and the anticipated up move ahead of this news, do you think, the worst is behind for metals and we start looking at this sector?
Yeah, good morning, Mangala man. Thank you for having me on your show. I'm sure it'll give a nice bounce to steel stocks. But end of the day, I think, do you want to invest in an industry which requires government help for protection? So that's the question which I'm not able to answer correctly. And, it's a very cyclical industry, a lot of volatility in earnings as well. And when markets are recovering the way they are, and with so many new choices coming up, I think it's better to go for other sectors, maybe other investment themes, rather than steel stocks. But there's no denying that they could be in for a nice trading bounce. Valuations are attractive and improved capacity utilization and volumes also could drive earnings. And then the base effect benefit also may come into play. So you could have a good run for steel stocks. But as a new investor in this sector, I mean, I'm not sure it's a good idea.
As a new investor, not a great idea. We're not sure whether it's a great idea. Deepan, stocks are seeing some repair and recovery, and that's good to see, right? You've been gasping for breath, and there's some air in the room.
I'm also
we all are. What's your sense, Deepan? I've been saying for at least a week, price-wise, bottom seems to be in. And momentum, how long it'll last, whether it's fleeting, etc., we'll see. But what is your own perspective, and where is interest activity likely to be if we've seen the lows already from here?
Yeah, Prashant, good morning. First of all, for us to completely conclude and have the comfort that we have a strong bottom in place, you need to see a trend reversal. We are seeing lower lows and lower highs. We need to see higher highs and higher lows. So once that pattern gets established, then you can be sure that, okay, now the worst is over and gradually the markets will build on the gains and we have a foundation in place. So that's one important pattern that you need to look out for. Secondly, I think that it has to be India growth stocks, and it could be the same stocks which did well in the last phase of the bull market, which started from October 23 to September 24. But broadly, it has to be India-focused companies and maybe beaten down sectors, which is why I came to cement, to an extent retail and banks and BFCs, because I feel that there's some value over there and growth rates will pick up, base effect will benefit them, and RBI cutting interest rates, government budget benefits of a rebate, all of these will definitely improve consumption. So the investment themes will be again India-focused companies. But as I said, I think for us to be completely sure, we need to have a reversal of the pattern which we saw in this last 5-6 months or so.
Okay. Deepan, in terms of stock action, yesterday the momentum was back in such a big way. Everybody's lapping up PSU stocks again, defense stocks again. Even the railway names were tracking big gains yesterday. Now, that could just be because they've been beaten down, right? I mean, 3-4 months of absolute thrashing. But what would your advice be? Should one be looking at areas like railway or defense at all?
Good morning, Surabhi. I think this is the effect of a risk-on trade from domestic investors. And these companies have created huge wealth. They've been multi-baggers past 4 or 5 years until about 6-7 months ago or so. There's been a steep correction. But if you notice over the last 2-3 years or so, fundamentals have only improved. And they're sitting on decent order book position. There's good order visibility. And whatever government policies, encouragement is there, that continues. So I think that investors want stability in earnings and they're buying these companies. And I completely agree with that strategy. Quite positive on defense companies, on PSU, capital goods companies, on railway companies as well. You can pick and choose, but I think companies like HAL, Bharat Electronics, Bharat Dynamics, I think they are the best placed in terms of size, in terms of business model, and in terms of the kind of potential which they have in the domestic and the export market.
I take your point entirely. Partly it could be risk on, partly it could be NAV propping because these stocks have seen a big decline from the highs, partly could be the effect of the last 15 days of the financial year as well, where companies try and close their order books. So a bunch happening out there. We'll keep an eye out on this. But we started our conversation with the metal space, right? So let's get an important voice coming in from there itself. Vedanta's Anil Agarwal promises to reduce debt by about $3.5 billion by 2027. In an exclusive conversation with CNBC-TV18 Shireen Ban, he says that prices of aluminum and zinc are seeing premiums like never before. Let's hear out the excerpts of that conversation.
What about the global environment today, Mr. Agarwal, and how that's likely to impact commodity markets, specifically things like aluminum and steel? We have, of course, seen an escalation as far as the tariff war is concerned. President Trump imposing tariffs, other countries retaliating with reciprocal tariffs. What does all of this mean now for commodity markets? How are you reading the developments?
We are watching, but we have a less impact because we are domestic player. Our Indian consumption is so high. In any case, aluminum, US need. Aluminum does not produce basic aluminum. So they purchase a lot of aluminum alloy. And we are developing those alloys, and those alloys will be very important for them. So we are definitely watching. It is impacting to everybody. But as far as Vedanta is concerned, whether it's oil and gas, whether it's a zinc, whether it's a copper, whether it's a aluminium, we are worried about as a overhaul what will happen, but Vedanta will be less impacted.
Less impacted, you believe? We've also seen the DGTR, sir, recommend the imposition of a safeguard duty to the tune of 12.5%. That, of course, has to be ratified by the Finance Ministry. So there is still a wait and watch there. But what do you make of that? And do you believe that this is warranted at this point in time? And is this enough?
I think this is enough. Government is working very, very hard to make sure industry run well, and those days has gone where government used to take long time to take decision. Now government is absolutely there, and to make sure the government, the business, because we are heading towards $5 trillion economy, and we cannot take any chance to reduce the production, slow down the production. It is very, very important for us.
Yes, that certainly is the case. I also want to understand from you, as far as prices are concerned, if you can give us a forecast or an assessment or an estimate of where you believe prices are going to be across the board for each of these commodities that we just spoke of, whether it's aluminum, copper or zinc.
There is a short supply, huge demand. The warehouses are empty, and everybody is looking at. We have never seen premium on the aluminum what we see today. Highest premium in the zinc is the highest premium. Or gas. Can you believe that gas in India you can sell at $10? And same thing on the oil. So it is a time. It shows that how much is the consumption is increasing in India of this metal. So prices.
That's a big.
Yeah, go ahead.
That's a big statement, Mr. Agarwal. You're saying you've never seen the kind of premiums that you're seeing, whether it's aluminum, zinc or gas.
Absolutely. This shows the growth in India, the consumption pattern in India. Of course, it has American, what they are doing on the duty, it also has an impact. But the consumption in India of this metal are growing like anything. All double digit.
All double-digit growth is what you anticipate. Let's talk about debt as well, Mr. Agarwal, and your plans as far as deleveraging at the parent level was concerned. You've been able to deleverage to the tune of about $1 billion. The average cost of debt is about 11% versus over 13% at the start of the year. If you can lay out for us what the debt reduction plan is from here on.
I think we are the lowest debt in terms of our peer group is concerned. You know, that total debt, if you look at, we are the parents about $4.5 billion, down the line about another $4 billion. So about $8 billion. Against this year, we are going to have close to $6 billion EBITDA. And in another 15 days, we'll be declaring that it's hardly any debt if you compare anything. But we have a full plan that will be completely reducing our debt on the parent company in 3 to 4 years' time.
If you can add a little bit more clarity on that debt reduction plan at the parent level over the next 2 to 3 years, you believe that you're very comfortably placed today, but if you can draw out the roadmap for us with a little bit more detail.
So in this year, 25, we are going to reduce $1 billion debt. 26, we are going to reduce another $1 billion debt. And 27, we are going to reduce $1.5 billion debt.
All right, so $3.5 billion over the next 3 years, as clearly pointed out by Anil Agarwal, also saying that demand for metals is extremely high, including that for gas, etc. as well. Last 1 month, the stock has done well. The next trigger, obviously, is the demerger, and the kind of value that it creates for shareholders is something that we'll most definitely keep an eye out on. But we're still with Deepan. Deepan, you started on by saying that, steel offers an attractive trading opportunity. But from a Vedanta standpoint, where do you see, value being generated? The management has been speaking about debt reduction. There is that demerger that will take place as well, which they've been speaking about as a big value accretive measure. Would you buy into that?
Yeah, Mangam, I think so. And there's a good, I think, value unlocking opportunity, or call it an arbitrage opportunity. So if Vedanta's current market capitalization is 1,80,000 crores or thereabout, when they split the company and all the companies have identical shareholding pattern, that could be a value unlocking scheme. And you could easily have a 10-15% type of appreciation of the combined entities when they get listed separately, as compared to the consolidated entity which is listed just now. So yes, I think there is a good trading opportunity. There's a good arbitrage opportunity in Vedanta also. And by the way, it was an excellent interview. And I think a lot of facts came out very clearly. So with the management sounding so positive, you could certainly consider this stock.
All right, 460 as far as the price is concerned. And yes, I mean, especially on aluminum, which is the prime driver for Vedanta. I mean, Mr. Agarwal actually sounding very, very confident. Let's take a quick commercial break here. We're going to be joined by Sudarshan Sukhani, Mitesh Thakkar, some technical trading ideas coming up in just a bit. Welcome back. We've got the pre-open, which is going to come up soon at about 9 minutes or so, and 116 points higher on the GIFT Nifty. So the gains continue, and we're building on nicely, and the market gains are broadening out as well, which is, I think, also an important thing. Mitesh is with us with his trades and what he'd like you to do. Mitesh, good morning. Welcome to the program. What's the sense, Mitesh? 22,900 or so is where we left off. What's the next stop, and where are supports, etc., going to be?
Morning, Prashant. So, last few days, once we started getting past 22,600, 650 zones, we have talked about targets of 22,800, which was met very easily. Then 23,150, I think we are heading towards that. And logically, I think the way this reversal is shaping out, I think good chance that we'll even make an attempt towards 23,500, 600 zones. So my eventual target is that. But in between, there's a pivot at 23,150, 160, 170 zones. So I think around those levels, tactically, you might want to take some profits once we reach over there. But till then, I think stay long. Use any declines in the last 3 days have been very good for the markets. But in case you get an intraday decline, I think buy into it. For the Nifty, the preferred buying zone is around 22,750, 700 levels. For the Bank Nifty, the corresponding zone is around 49,200 to about 300 to about 200 zones. And for the Bank Nifty also, I'm looking at 50,400, 500 as the target area. So both the indices are suggesting that there should be more upsides in coming days, even if you get an intraday decline. So therefore, I think I would maintain clearly a long bias.
All right, a long bias. What individual stocks would you be backing if the bias continues to remain long?
Good morning. I have all buy calls. Yesterday, I think, there was some breakout in the Nifty reality chart, so I've got two of them. In fact, Godrej Properties was a buy yesterday as well as a BTST call, but now can be bought as a trading position. Keep a stop at 2074 for targets of 2185. And DLF also had a good short-term reversal kind of a pattern on the chart. So buy here with a stop at 688 for targets in the range of 720 to about 725. That apart, a buy on Bank of India with a stop at 100 for a target of 109.5, which is close to its 200 average. And Apollo Hospitals is a conditional buy. It's close around 64.20 mark. I would want to see the stock take a minor pivot, which is around 64.45. So buy above that. Keep a stop at 63.90 and 65.80, 6600 should be your target.
Okay, all right, got it. Mitesh, thanks very much for those trading ideas. Let's welcome in Sudarshan as well and get his sense on today's market action. Sudarshan, morning. It's been a big, sort of green up move. What about the indices? What's the trade you're taking, Nifty or Bank Nifty?
Yeah, good morning. In fact, I was away for 3 days taking my 7-year-old grandson to Dubai, and that was a very wise idea. The markets behaved very well in the meantime. That's going to continue. See, what happened is this. we went into a deep correction. After that correction, for almost a month, the market went sideways. That's exactly how a base is built. From that sideways move, the market has broken out on the upside. We are seeing probably the first leg of this up move. At some point, we will pause. At some point, we will see another sideways move or a minor correction. But the intermediate trend has also turned up. So what will happen in the future is a different matter. But currently, there is only one trade. Every dip is a buying opportunity. And not only that, when the market goes sideways, we will see stocks doing rotation. So on the stock side, also focus on the buys. But for the Nifty, clearly, if you get a
Oh, I think. Right. Oh, sorry. So, Darshan, we just lost your feed, but I think we have you back. Also, tell us about the individual stock trades then that you'll recommend today.
All right. Zolto is a buy with stop under 219. Zolto is coming after a long time in my list. Syngene is a buy, although IT stocks have not done well. Perhaps the time is changing. Consider buying with a stop under 691. SBI Life is a buying opportunity with a stop under 1450. And finally, Concor is a buy with a stop under 670. I'm repeating again, focus on the buys. Don't go for anything short.
Okay, all right. We'll take a quick commercial break here. We'll come back. Sudarshan, thank you very much, and I hope you had a good trip. Looks like you did. Dubai it was, right? You said. Thank you. And of course, Mitesh, appreciate you joining us as well. We'll speak with both of you in about 10 minutes time and take stock once again. The pre-open session is going to be starting in about 4 minutes or so. We're going to come back with Kumar Rakesh of BNP Paribas to discuss key trends in the IT space. I mean, the sector was, a meaningful loser. It was down 2% at one point, ended about 1% lower. The index itself and most names under pressure. What's the road ahead? Kumar Rakesh tells us.
Welcome back. 15 minutes to go before we start getting our rates. Let's get back to Deepan with a couple of thoughts and ideas. Deepan, I want to talk to you about the best performing stocks on the Nifty so far this year, 2025. And it's the Bajaj twins, both finance and FinServe, right? There's so much of news flow happening, plus there's overall interest, and the consensus buy call in the market right now seems to be blue chip financials. What is your take on both the group companies and, of course, this latest buyout of Allianz?
Just to be first, a disclosure that Bajaj Finance is our core holding, top holding, in fact. And for 5 years, patiently, we have been waiting and the stock has really gone nowhere. The Nifty and all the other small mid-cap stocks have been multi-baggers, but Bajaj Finance has been flat, almost flat. And now it has shown amazing strength. I think when the Nifty was down 13-14%, Bajaj Finance was up 15% or so. And I think that in the next leg of the bull market, Bajaj Finance could clearly be the absolute sector leader, and even amongst the Nifty stocks, the Nifty leader. So very positive on Bajaj Finance. I think a lot of concerns are getting gradually addressed. There was this threat from Jio, but that is no longer as severe as we thought earlier. And the NPAs and the collection efficiencies have all gone up. And the advantage of being multi-product certainly benefits Bajaj Finance, and its size is also quite important. So very, very, very positive on Bajaj Finance, and may not be a multi-bagger from these levels, but certainly could outperform the benchmark indices.
Deepan, another pack which did very well. I'm not sure if there was no news flow per se. Mazga, the shipbuilders, Mazga was up 10, Garden Reach, Cochin, all double-digit gains yesterday. Always moves like a pack. And of course, the other defense, the HAL, the world, did not really move. Any interest here and any picks?
Yeah, I think these are also all great companies, and all these shipbuilders have many, many years of earning visibility because of the kind of order book position they are sitting on, anywhere from 5 years to 10, 12 years or so. So very positive on the sector as a whole. And I think there is some incentive given for shipbuilding in some of the tweaks they have done to the Bharat Mala policy by the government. So there is some positive news flow. I just need to analyze it a little better and see the impact. But nonetheless, I think there's a huge export market for these shipbuilders. There's also the repairs and maintenance component or the division that has also got good potential for growth. And all the valuations are on the fair side. I would still see that these stocks can at least perform in line with the sensex nifty. And as a shareholder, I would like to remain invested.
Okay, now this is a slightly off-tangent question, Deepan. How do the completely bombed out names, anything just because of price damage, sheer price damage, do you feel chance le lete hain? Any names there in that chance le lete list? You know, yesterday, for example, you had Idea Forge, Fusion Microfinance.
The one stock, Prashant, which I'm thinking of day in and day out, and I'm resisting from buying as a matter of disclosure, is IndusInd Bank. And I rarely average, but I'm really considering over here. I'm very tempted. But then when I look what happened to RBL and Yes Bank, I'm just like holding myself back. But I don't think IndusInd Bank is in that category at all. But it's completely bombed out. It's extremely attractive. It's a great bank. And now entire banking sector also is looking up per se. And I think that this stock has been a bit too much beaten down. Whatever the damage was, it's a one-quarter phenomenon. I mean, they'll write it off in one quarter itself. But beyond that, I think, you could see improvements in earnings. The only thing which bothers me is the confidence of the management to, again, grow the loan book. Because what I have seen is that after you have so much of stress and so much of negative surprises, the management becomes very conservative and they don't go ahead and lend, and suddenly the market shares start to come down when it comes on the lending side. So that's one concern. But it's one bombed out stock that investors can consider. And if you have a kind of a strategy to go for such stocks, then why not have a look at it?
That's an interesting one that's coming.
Deepan reminds me of that line from the very famous OTT series, risk hai to isk hai, all of that. But he's still thinking about it, and that's a caveat that he's put out
The
there.
caveat is that risk hai. So we will just keep an eye out on that one. From one beaten down sector to another beaten down sector. Let's speak about the IT pack. Is there an exciting entry point here, or is there not? Is it still, uncertain out here? Let's get in Kumar Rakesh, who's the India analyst, auto and IT at BNP Paribas. After a big decline that we've seen in the IT pack, there were brokerages which still believe that, the decline is largely earnings-led and it is not multiple-led. And at times where it is multiple-led, it is justified as well. Where do you stand on that? And do you think after this crack that we've seen in the IT stocks, there is an attractive entry opportunity? If yes, then where?
Hi, good morning, and thank you for having me on the show again. So last week we were in Hong Kong, Singapore meeting investors, and we could see this very high level of bearishness that has gone into investors' expectation for the sector. Till last year, when we were meeting investors, till late last year, early this year as well, the only pushback that we used to get on our positive stance on IT was around valuation, although almost generally everybody had started accepting that the recovery is underway and we should start seeing better growth in the next financial year. And valuation was the only holding point. Now, while the valuation has sharply corrected, we noticed that investors now have started expecting next year growth to be similar or possibly much weaker than what the companies would report in FY25. Now, where to look from the entry point to your question, we think between now and April, we'll see more of consensus earnings cut, a little bit of more moderation in terms of what the next year growth will likely look. Companies will come out with their guidance in April month, and we think that they will set expectations also quite modestly and give guidance which could be conservative. And that we think should set the bottom in terms of expectation from the sector going into next financial year. And having already seen the valuation correction, we think by April, we will start seeing some attractive entry point to start looking at the sector favorably.
Okay, that's interesting, Kumar. Hi, morning. You're saying that maybe April onwards, there could be entry opportunities. I'm just throwing Citi's argument at you because yesterday that report was doing the rounds and they are of the opinion that at least for the large cap, let's talk large cap, let's leave out mid cap for the time being. Large cap IT growth rates now with the new reality in the US may still be about 4-5%, nothing more than that in the new fiscal. And then their argument was that valuations are perhaps therefore still expensive and still above long-term averages. Your thoughts on large cap IT?
Hi, Surabhi. So I think that is a very fair question if you look at from pre-COVID period when the growth used to be mid-single digit, about 5 to 7% for the sector. And the sector used to trade at multiples below 20 times. And hence, if that is the new reality that we are thinking that the sector is likely to continue to see these tepid growth levels, these valuations may start looking expensive. But our view is that demand outlook has dramatically changed post-COVID. Of course, there are macroeconomic headwinds, and that is what we are dealing with right now. But as we start coming out of this, we should start seeing growth, which is much better than what the numbers which we are talking about here. You just look at the YOY growth on a quarterly basis, not on the full year basis. Many of the companies in the Indian ITs, among the large caps as well, start moving towards the high single digit by third quarter or by fourth quarter of financial year. So if this incremental slowdown in the macroeconomy, which we are talking about, wouldn't have happened, we were already on the trajectory towards a high single digit sort of a revenue growth. And the demand tailwind from GenAI and the broader economic recovery in terms of multiple verticals starting to push growth hadn't already started playing out. So we still see that there is a path for a high single digit, close to double digit revenue growth for the sector. And if that is the case, we think looking beyond FY26, these valuations may still be justified.
This high single digit, almost touching double digit full year growth, by which year do you see this happening?
From FY27 onwards, so if you look at last couple of quarters, most of the growth was driven by BFSI vertical, where we had seen a broad-based recovery to start playing out. In December quarter, we started finally seeing recovery to start coming into CPG retail and energy and utility vertical. But there's long tail of other verticals which were yet to start pushing growth for the sector. And that happens when the entire economy fully recovers. The signs of that we started seeing in the month of January. US manufacturing PMI, which was below 50 levels for the last 2 years, had started reporting numbers above 50, getting into expansionary phase. Manufacturing is one of the vertical which was still declining for the sector. And hence, from the broader recovery perspective, we had started seeing signs to come through by January. Of course, since then, things have moderated, and we'll have to moderate our expectation in the near term. But we shouldn't dramatically change the view from a long-term perspective.
What are the risks to your call here? Because, the macro data emanating from the US does point towards growth slowdown out there. So does the commentary coming in from a lot of the verticals out there, which, are big clients of the Indian IT services companies itself. You say that there are concerns of a demand slowdown, but it's not a sign of weakness, it's a sign of caution. When does that caution turn into weakness? What are the risks here?
Right. So the base case with which we are working with is the impact on the macroeconomy related to tariff and counter tariffs and related uncertainties is a transitory effect, possibly lasting a couple of quarters. And if that base case changes and we start seeing the impact of that to be more long-lasting, that is the main major risk that we are working with. Last night, commentary from Fed was reassuring in that way. Even they see the impact of tariff to be transitory. While they are raising their expectation on inflation, they are not taking steps to act on it as yet, because they think these impacts are more transitory and should stabilize from as we move a few quarters from here. And that is the base case with which we are also working with in our estimates. But yeah, that is something we definitely need to keep watching out. If these things do not start settling down in a quarter or two, then possibly we'll have to take a longer look as well. How is this a new normal?
Finally, Kumar, on mid-cap IT, what are you liking? There are companies like Coforge that have just defied gravity, defied all odds, and they've just been, blazing ahead. There is the automotive space, names like KPIT, etc., which have been struggling last couple of quarters. Where do you see maximum growth in mid-cap IT?
So speaking with investors, at least the foreign institutional investors, they're not too keen to get back to mid-cap IT. I think they have to need the broader market momentum to start picking up. And that's when the attractiveness of the mid-cap IT starts coming back in. But if that happens, our top pick in that space is Persistent Systems, which has been delivering pretty solid growth despite the macroeconomic concerns. And as the demand recovers and the GenAI demand starts picking up for them, we would expect that growth to start picking up. Looking at PEG ratio, it still looks quite attractive. From a long-term perspective, we think that is one of the stocks should be part of the portfolio. I happen to cover automotive as well, as you know, and in that space, we'll have to watch out how much of electrification acceleration is still needed from global automotive companies. Some of the European Commission and governments are looking at slowing down the electrification journey, and if that happens, that creates a headwind in terms of the demand for some of the automotive ER&D companies.
Absolutely. So we'll have to keep an eye, but and of course, lots of news flow. US, of course, still the prime driver as far as Indian IT is concerned. So remains on tender hooks for now, news related. But thank you very much, Kumar, for joining us this morning with that perspective. Appreciate it. Well, let's bring in Sudarshan and Mitesh with their 9-10 call. Sudarshan, what do you have?
Well, SBI Life. Consider buying SBI Life with a stop under 1450.
Okay. Stop under 1450. The stock's at about 1490 right now. Mitesh, what about you?
Bank of India for targets of 1090.
Okay, Bank of India on the long side, both longs, and that's the texture of the market as well. Gentlemen, thanks very much once again. Let's talk about city gas distribution companies, and Axis Capital has got a note out. Sudarshan is here with details on this one. So over to you.
So Axis Cap has come out with a note on City Gas Company. It's positive on IGL and MGL, while it remains negative on Gujarat Gas. It has mentioned few catalysts. First one is aggressive expansion in network infrastructure, favorable CNG economies versus petrol and diesel, and addressable market has increased to total PV volume of the industry and supportive government policies. Amongst all the three companies, it prefers basically companies having the highest CNG exposure. So it has initiated coverage on MGL with a buy call and target is 1580. It has upgraded IGL to buy and target is 224, and it initiates coverage with a reduced call on Gujarat Gas and target is 390.
All right, take that point, Sudarshan. Thanks a lot for that. Meanwhile, we'll keep an eye out on market opening itself. Meanwhile, just watch out for Z. I'm looking at that one. We have, a CLSA note that has come by, which is suggesting that the stock could double from current levels, largely because of the big decline that it's seen, almost 55-56% decline ever since the fallout of the merger with Sony. Valuation's attractive. We've seen the promoters buy some stake in the company as well. Can things turn around for Z is something that, brokerages are betting on from lows.
Yeah. Do you know who's written it? Is it still, who's the analyst?
I don't think it is the same analyst as it was
I think
earlier.
Dipali
one of them. We'll just try and get some details on that.
We'll try and have the analyst on as well. And but that's an interesting one. We were talking about bombed out names, right, with Deepan earlier. Well, this is certainly a completely bombed out name as well. So more details on the note as well in terms of exactly what they're saying with Mangalam in just a bit from now. We've got market open a few seconds from now. So 130 points on the Nifty. You've got decent gains on the sensex. And there's a 0.5% higher open once again. 23,000 plus on the Nifty and 49,700 on the Nifty Bank. The small cap index is up about 0.8%. And 10:1, not 10:1, beg your pardon. It's 6:1 advances to decline, at least right out of the gates in terms of the market open. We'll have to give it some more time for things to settle. But this is a good looking screen, good open in that sense. Absolutely. 100 on the Nifty and about 300, about almost 400 points on the sensex is what we have. And I think the broader markets are doing just fine once again. Nifty heat map, if we have it, maybe just gives you a quick sense. I think it'll be all green, mostly all green. Maybe 10, 11 names in the red. Everything else is starting strong. Srubi.
This is a good opening, and off late the implied open has been spot on in terms of predicting the actual opening as well. Indeed, it's 100 points up, and 23,000 is on the screens for the Nifty. IT stocks finally are managing to recover after the drubbing they've received earlier this week. Wipro, Infosys, we were just discussing these names with the analyst at BNP. So there's some buying that's coming back. TCS is also about 0.7% higher. So that's a solid move for the market. And you have banks and financials. So both the twin turbo engines are charging ahead for the bulls. Banks and IT. IT I've mentioned. Let's look at banks. IndusInd is seeing some takers, 1% up this morning. There's ICICI Bank, there's State Bank of India. These are stocks on the higher side. SBI Life from the broader financial universe looking good. HDFC Bank itself is up about 0.5%. Kotak is higher. Axis is also higher, so banks looking quite good. Reliance is contributing, not too much, just about 4 rupees, thereabouts, 4-5 rupees on Reliance. But for what it's worth, it's in positive territory for the time being. Aside of IT, banks and Reliance, M&M, BEL, these are the other gainers. Adani Enterprises seeing some early gains as well. The only part of the market that's a little soft, JSW Steel, some of the metal counters are losing their sheen after yesterday's big moves. L&T is quiet, 0.5% lower. And there's a little bit of red on some of the pharma names like Sun Pharma, Reddy's and Pharma close to the flat line. But otherwise, it's a solid start, 100 points higher.
Points higher on the Nifty, and it's the IT pack which is leading it. The broader markets have been interesting moves, big moves as well. Z, for instance, we just discussed that pre-open, about 30-40 seconds ago. CLSA is bullish on the stock. It's opened about 4% higher. We've seen some traction in mid-cap IT as well. Emphasis, Birlasoft, Intellect, Design Arena, all of them up anywhere between 2 to 3%. But on the way down, I'm looking at all these cables and wires stocks. Yesterday we got an exchange notification from the Adanis that they've incorporated a joint venture for their cables and wire foray. The foray itself was known already, but the action that, they've gone ahead and incorporated a joint venture has the street worried because, again, this is, coming after Ultratech has made their announcement in this space as well. So we have KEI Industries down about 7%, Polycab down about 6%, Havells down about 5%, RR Kabel down about 2%. All these companies have said that for any conglomerate to come in and establish some certain market share out there which could impact the industry is still about 2 to 3 years away, but we are seeing some decline out there. Voltas, healthy analysts, maybe the street does not like the fact that the company is preferring growth and market share over margins, or perhaps it could just be routine profit taking after a 16% up move that we've seen on the stock itself. Jubilant Foodworks down about 2%. Remember, the Turkish lira has depreciated a fair bit, and they had, some exposure to that via their DP Eurasia JV. So maybe a bit of concern out there after the recent outperformance that we've seen. But no such problems for the stocks that have been doing well. Garden Reach Shipbuilders, another day, another big up move, and they've gotten a memorandum of understanding with the Nagaland PWD for a supply of 8 sets of double-lane modular steel bridges. So orders coming in thick and fast. Also orders coming in for Paras Defense. That stock's opened about 8% higher at the open itself. 140 crore order, if I remember correctly, announced just before market open today. That stock up 8%. So big moves on both sides. Mid-caps outperforming. And as things have settled 4 minutes, 5 minutes into trade, we have 2,000 stocks which are advancing for about 200 which are declining. But the ones which are declining are seeing massive cuts.
Absolutely. And, it's a good-looking screen, 120 points. So despite that, the pressure from... remember, earlier it was the Aditya Birla Group with their planned foray into this segment, the wires and cable segment. And that day, of course, stocks fell 8, 9, 10, 12%. And now it's another one. All the biggest volume-led gainers are all these wires and cable companies, as Mangalam pointed out. Mangalam was pointing out right before open, Z started 5% higher and it's got the second highest volumes on the NSE. So about 105 rupees, and we'll have details of what CLSA is saying on Z in just a bit from now as well. That's it. Otherwise, on the upside as well, volume-wise, it's a kind of slow start, but it, like yesterday, hopefully it broadens out. Eris is up. Eris Life Science is up 11%, and it's got some volumes as well. So that's why I'm making a quick mention of it. That's it. Otherwise, it's a decent kind of start. The number one volume-led gainer is Garden Reach with a 3% gain at this stage.
Actually, that yesterday, PSU move from yesterday, that's kind of continuing this morning as well. So you have some of the shipbuilders, have some of the railway stocks, some of the financial names, so Ircon, etc., IRFC. These stocks are still up and about. So the PSU move is also on. But I think Mangalam spotted the most interesting trend of the morning, which is wires and cables. And I remember what these companies said even after the Ultratech entry. They maintained a very brave face, saying that this will take some time, it won't be disruptive, etc. There was some recovery in the stocks. But the fact is, there have been two huge, big, deep-pocketed players coming in. Perhaps you can't entirely write off the competitive intensity that could maybe unleash ahead. So, yeah, all of them down 4-5%.
We'll keep a track of them. Vineet Samre is with us, Head of Equities at DSP Mutual Fund. Vineet, good morning. Great to have you with us here. Prashant, this side. Now, let's just actually, why don't we, we'll get to the markets in just a bit, but there's once again, effective competition. I mean, actually, more sectors, right? Competitive intensity is super high, actually increasing. Wherever there are lucrative margins, decent profit pools, there are entries, newer players coming in. I mean, we were talking to in the AC space. We had Blue Star yesterday, and we were asking them 65 companies in that space. But just your thoughts on this wires and cable segment, and I'm sure you have exposure.
Yeah.
Broadly, what do you make of it as an investor?
So, Prashant, first of all, let me agree that incrementally, most sectors, we are seeing a lot of disruptions, just not the competition, but also technology disruption, which is taking place. And, a lot of it is actually leading us to sort of go back to, our financial modeling and just see whether, some of this is still making a case. Are the companies losing their core moats? So I think the investment climate overall is becoming very, very challenging, and we have to be sort of very alert in terms of how the companies are keeping up with their competitive modes actually. So that is one very important aspect. Especially on the wires and cables, let me say that I was trying to look for the history when a similar thing happened in case of paints business as such. And when we go back in 2022, when Grasim made that announcement to get into the paints segment, actually we had seen the paints company for 6 months still doing well. Maybe it was because of the demand environment. And only after 1 or 2 years, it really struck that it's hitting up and it's going to be impacting their profitability. So we saw the reaction in the stock price maybe 2 or 3 years down the line, and the stocks, I think, corrected by 30-40%. And this playbook was available as the announcement happened in case of wires and cables. We saw that immediately the stock price actually reacted. So, I would imagine that the business opportunity is going to be large. Today also, when we think about the power sector investment requirement, not only in India, but globally, I think it's going to be huge. And from that perspective, some of these companies would still continue to see maybe decent growth. And the new entrants will also have maybe 4, 5, 7% of the overall market by FY30. But important point is that the stock reaction has already happened this time because the playbook was available. Investors got worried very soon, and 20, 25, 30% reaction has happened. Maybe some more reaction and the stock starts looking attractive from valuation perspective. I would believe that the growth challenge is not going to be there for these companies, and hence at some valuation, it would make sense to sort of look at some of these companies as such.
That's an interesting one. So some correction has already happened, a little more, and then it becomes attractive. Vineet, always good to speak to you. There was an interesting analysis that came from your house, which was when the mid-cap index was down almost 23-24% from the highs. The analysis was that about 8% decline was due to earnings degrowth and 15 to 17% was due to derating. Now that we've seen a recovery from the lows of almost 5 to 6%, how much do you attribute to improving earnings prospects and how much do you attribute to, valuations resetting?
So, Mangalam, this is all very short term and driven by sentiments rather than any big earning change. I think for me, if you ask me, I still consider that March quarter will be, again, looking like downgrades of earnings from where we were. And this is coming from, the commentaries we are listening from the managements. It's a bit cautious. And I think you guys are also talking to the management. There's no real, recovery, which is broadly seen across different segments. And hence, I would imagine that we are still under some risk of earnings downgrades, maybe 1 or 2 quarters more. But good part here, Mangalam, is that, we have seen 4 or 5 quarters of sequential earnings decline. We already have seen a low base creation. And in some form or fashion, the macros eventually should sort of turn as, we see that monetary fiscal, some bit of that space is easing out with the stance taken by RBI. So, and the hope is that consumption should start seeing revival maybe towards the end of this year. So I would say that things can turn around from here. Maybe 1 or 2 quarters of pain. Markets will slightly be ahead of that. And hence today we are seeing these corrections and then bounce backs. But I think there are, from the corporate side, some more pressure points still may be there in the quarters to come, 1 or 2 quarters.
Vineet, hi. Good morning. Good to be speaking with you on the show today. So since you're saying that consumption is likely to bounce back, let's talk about how you'd play it. And there's been enough debate around it, right? The top-end premium level consumption, but then we got into the narrative of the urban consumption slowdown. After the budget, the narrative changed to that now that there is, people have 1 lakh rupees extra to spend, they'll go to QSRs, etc. So you tell us, what are you convinced about in consumption?
So I think, Surbhi, you're right. It is very unclear, and the wallet shares are changing. People are also now traveling a lot. They're spending a lot on hotels. We don't know where exactly the spends are going to take place. But the way to think is that we go back in history and see that. So first of all, we have benefits of taxation. The welfare, schemes are maybe giving some more benefits to the people. Inflation coming down is good for the rural folks because they were affected post-COVID. And I think towards the end of this year, we'll start talking of the 8th pay commission benefit, which last time around, it did help auto sector in a big way. So, instead of really focusing on where exactly we'll see the benefits, I would say that we'll have to create basket of consumer discretionary stocks as such, because we believe that these are durable. The tax benefit is a durable benefit, and people may want to build these kind of assets where on the discretionary side it can be auto. People may like to spend on hotels, QSRs, and all of those. So we have exposures out there, and we are actually incrementally looking at this space. Maybe retail at certain valuations could become attractive. Right now they are all going through a bit of a slowdown. And what Prashant mentioned, I think one thing which we'll have to keep worrying about is the competitive dynamics across the space, which has become a very important factor to think before we buy with a long-term view.
Sure. So you mentioned that in this basket of discretionary consumption, you'll probably put autos, maybe hotels, maybe retail at some point. Where does that leave quick commerce and the platform companies? Because the problem is their sales numbers were fine, even the profitability looked okay, but now they're reinvesting in the business, they're opening all these new dark stores, and the market got a little worried. Where are you on that space?
There, actually, we are still seeing the competition is heating up, and that may not still mean that these companies will see light at the end of tunnel soon in terms of the profitability, and which is where we have taken a sort of a pause out there in terms of going aggressively on those names. But we are watching that space. We know that, as I spoke about the wallet share, I think they are catering to a big need which is there. Just that need needs to get converted into pricing power, and that should eventually deliver profitability. If that path becomes clearer, I think it would make a good case for investment out there.
It's interesting, some of the names that you hold in some of your funds, you do have small ticket discretionary items from the consumption space like Safari, you have Thangamile, LT Foods. Interesting, updates coming in from the retail and textile world as well. Vineet, the question I'm curious to know the answer for is, in this decline that happened, did you top up on already existing names, or did you buy something else as well, which was always on your wish list, but because it had run ahead, you couldn't buy it, and now the valuations seemed attractive? If you could give us a sense of what you did.
So a large part actually went into our own existing stocks, because there we already have our own understanding of businesses, and we slightly increased the exposure. And we also took this opportunity to maybe cut exposures in names where we felt that the overall outlook for them would be slightly more elongated in terms of recovery. And new names we keep watching. So as a proportion, I can say that maybe higher allocation to the existing names versus the new names. And new names also are finding their way into the portfolios as well.
What would the nature of those companies look like, the new names?
Yeah, so I think it is to do with where the businesses have seen low cycles. So specialty chemical as a pack is one area. Auto ancillary, I spoke about the auto, but auto ancillary seems to be a better way to play all of these. Some consumer names we are watching. So I think in and around these segments, the names would sort of lie.
All right, Vineet, thank you so much for joining in and giving us your views on the market and talking us through the sectors and stocks that are not specifically stocks, but ideas that you like after this correction itself. But One of the sectors on our radar is the capital markets theme itself. CAMS as a company is on our radar. It signed an agreement with LIC to provide insurance repository services. To discuss this and more, we do have Anuj Kumar, who's the managing director at the company, who joins us now. Basics first, Anuj, thank you so much for joining in. What does this do to your incremental revenue, additional users, market share that comes in, this tie-up that you've done with LIC?
Hey, good morning. Hi, and thanks for having me on the show. So broadly, you will know that the insurance repository has been in existence for over a decade, but hasn't got the impetus and the push that you would expect. So therefore, LIC joining up, I think, is directionally a great thing for the industry, because a large market leader with that kind of market share had stayed away from this architecture. What this does is that we have now close to 80 lakh plus EIA accounts. All those account holders, practically everyone will have an LIC policy. They will be able to bring this into the realm of servicing through that. LIC over a period of time within 2025 will move some of their new issuance. They may not get the legacy policies yet, but the new issuance will start moving into this architecture. So you can have your LIC policies, both new and old ones, as you like, in the insurance account. On top of this, you would be aware that we have Bima Central, which is the unique unified servicing platform, where you can manage your entire portfolio at one go, including transactions over a period of time, lien marking, borrowings, all of those things. All of that will get enabled. So I think it is structurally the right thing to happen for this segment of the industry.
For you, sir, Prashant here, good morning. This is about, the repository is about what, less than 2% of your revenues? So far?
That's correct. It's less than just about 2% of our revenues. So I think we are not expecting a large kick-up in revenue because of this.
Yeah. No, LIC, if you just count the number of policies out there, LIC is about an 80% share of all policies. Now, with LIC coming on, as you said, this does shake up things a bit. Would you expect, 20, 30, 35% kind of growth in this business? I mean, from a low base, obviously, that is one. And second is, could you tell us what is the cost of doing, what do you charge as margin on these policies?
So it's a very simple charging mechanism. Every time an insurer brings in a policy, he pays a charge of conversion or dematting, which is between 5 to 10 rupees. And then they charge an annual maintenance, which is also in a similar range. So that is what they end up paying. So the rules of large numbers apply. I would think certainly this business is poised for growth. I can see that number to be in the range of, let's say, 25-30% for the coming year for FY26. It's also great signaling to the rest of the market, which hasn't yet aligned to this architecture. So you can find that a lot of the others will also start lining up. Just to share, someone like Star Union and Daiichi brought in their entire policy base to us last year, which means those are insurers which are complete believers, and they want to get into this 100%. I think that momentum will increase now.
NSDL, CDSL, etc. also will start doing this. You've kind of beat them to it in terms of, but do you think it gives you a kind of first mover kind of advantage here?
It gives us the first mover advantage in two ways. By the way, LIC will sign up with all the IRs. It is not that they're just signing up with us. We are the first to sign, but you will see that happen in the next month or two. They will tie up with everyone and give consumers a choice. I think the way this game is played is that the larger number of e-insurance accounts you have, because each citizen is allowed to have one, you can get as much market share as you drive the EIA count, because then whether the person has an LIC policy or healthcare, everything gets into that account. So that's the direction for us to take, to focus on maximizing coverage of EIA and then signing up with as many insurers as possible progressively, so that those policies then get inside the EIA accounts.
So just to completely understand the full picture on this, you're saying that this business should grow at 25-30% over the next couple of years. Tell us two things. One, the margin profile of this business and how it compares with, say, the mutual fund business that you run. And if it grows at 25-30%, that let's say by FY27 or so, how much of your total revenue will start coming from this business, and what does that mean for overall profitability and margins?
So this business is a small business right now. Like you said, 2% of overall revenue. So think of it as a break-even business. It is not a margin accretive business right now. As we kind of drive the momentum and help this grow by, let's say, 30%, this will get into double-digit EBITDA in the next 2 years. That's our aspiration. It will still not be materially contributing to the overall book. The overall book is very large. You know that we are a company with about 500 crores of PAT. So when it will start influencing, that may take another 3 or 4 years. But from a size and growth perspective, things look pretty strong.
5 to 10 rupees is what you said, sir. Is it 5 or 10? Or is it somewhere in between? What, in terms of what you charge, one time and then annual maintenance?
Yeah, it's not a flat rate. It depends upon what deal you get with individual insurers. It is in that range.
Okay. Also, I mean, you said that it should get to double-digit EBITDA, say maybe by FY 27, 28. Overall, you're operating at 40% plus margins. So in that sense, for the next couple of years, this is not really like you're saying, it's not really about margin creative growth.
No, think of this as a platform business. We've laid the rails, we've done the plumbing, we've acquired the customers, and we have the accounts for them to place their policies. Momentum builds over a period of time. That's exactly the momentum we've seen in other platform businesses. So what I'm very positive about is that foundationally, as we grow from, let's say, 80 lakh to 2 to 3 crore e-insurance accounts, the number of policies will multiply. I'll give you one simple metric. Every quarter, we used to get about 500,000 in DMAT till about a year back. This quarter, that number is 1.5 million. Our objective is that 1.5 million doubles from here in the next 2 years and becomes about 3 million. At that size, this is, it has every kind of, indication to become a large material business for us.
Let's talk about, your core business here. The mutual fund AUM actually declined by 1% month on month. The inflows have been lower. It's a function of the markets itself. And then the most important part, SIP stoppage as well, increased by about 123%. So does that have an impact on your MF business? Are there any concerns on growth out here? And you were also renegotiating a couple of contracts with 1-2 players. Has that happened? At what levels?
So I think the primary metric, which is MF AUMs, have held very well. If you see whatever has gone off 4Q over 3Q, overall AUMs have not declined by more than 3%. Equity has not declined by more than 4%. This is despite that mark-to-market losses have happened over a period of time. One of the biggest contributors is that net sales, which were over 1 lakh crore a quarter, let's say 1.5 lakh crore, held at 1.5 lakh in 2Q, held at the same number in 3Q. I think in 4Q, there'll be a fall. It'll still be over 1 lakh. So a lot of makeup has happened because investors continue to bring their monies into the industry. It is very similar for our assets also. Our equity assets are down about 3% quarter on quarter. Overall assets are down about 2%. So there's nothing alarming there. The real metric you should see is new SIPs, because what's happening on net is that there is some one-time closure of accounts. The industry has been very disciplined in shutting down SIP accounts. If an investor has 3 successive bounces or 3 instances of non-payment, I think in the momentum, some of those closures got delayed. So you're seeing some, over par closures in Jan and Feb. You may see that in March. If you continue focusing on new SIPs, which is a great metric to see, the industry was getting about 2 crore a quarter in 2Q. That number is down to about 1.5 crore. So it's not a bad number at all. From those numbers, we do not see any panic at all. And from a 2 to 3% AUM erosion, I think that's a very good number, which is going on in fourth quarter.
Got it. All right, sir. I had more questions, especially on MF Central. Maybe, we should get you on Let's Talk Money for that, because for consumers, for users like us, that's the next big thing that we all are watching out for. But thank you very much for the business update, and look forward to the next conversation as well. Well, let's move on now and put the spotlight on CEAT. That's the next company on our radar. It has launched a new range of tires under the Sport Drive range that includes ZR-rated 21-inch tires, run-flat tires, and low-noise calm tires as well, targeting specifically the luxury and the premium end SUV segment. Our colleague Sudarshan caught up with Arnab Banerjee, MD and CEO of the company, and began by asking him about the launch.
We have launched 3 tires with new technology. One is the run-flat tire, which will keep you safe even if the tire is damaged. You can drive up to 80 kilometers and get it fixed. Second is the calm tire, which is a low noise tire, which is becoming very relevant in terms of long road travel over highways, electric vehicles. And the third is a high speed rating tire, Z-rated tire in 21-inch. So all these tires are targeted towards customers who are evolving from just commuting to exploring on the highways, driving electric vehicles, and also off-roading and going long distances. In terms of strategy, we are targeting the premium end of the market, which is about 8 to 10% of saliency in the overall car tire aftermarket. This is going to grow much faster than the rest of the market, and this is going to grow to 25 to 30% saliency. So if we have ambition, and we have ambition to improve our competitive position in the market, then this is a segment where we have to fortify our position. So these three launches are going to do precisely that, and there will be many more coming in the near future.
So what will be the price range and any market share that you would be targeting?
See, our market share is about 16% plus overall. So we would definitely like to be over-indexed in this segment. So we would like to have at least 16% or closer to 20% share in this premium segment, which is the 17-inch plus segment, which is what we define as premium segment is. So these three launches are going to aid that process.
So now shifting to operational metrics. So I'll start with the demand issue. And especially on the domestic front, we have seen that over the last at least 2 to 3 months. Now, apart from four-wheelers, demand has been sluggish even for two-wheelers. So how is your ground check? How exactly like your customers are saying?
So I think you are referring to the OEM demand. So yeah, OEM, I think four-wheeler has been slow in terms of its flattish, low positive. Two-wheeler has been growing well actually. They've just touched the FY 19-20 levels.
Retail sales, if you see like over the last 2 months, it has come down. And like in the last conference, like these companies, even for FY 26, they are not so bullish.
Yeah. Right. So how we are looking at, first I'll address the OEM segment tire sales. So we had mentioned about exiting some vehicles in the last 2 years, which we did because of reasons that these are not going to grow these sizes of tires. So we are coming back into the OEMs basis the approvals that they've got and the visibility of that. So our growth rate in OEM is pretty okay, even though overall OEM sales is in some segments is slowing down or flattish. That's one. Replacement market size, see the commercial market, commercial tire market, truck bus radial market is going to grow by mid-single digit because that kind of mirrors the GDP growth. The passenger growth has been slow in aftermarket, so we expect that to at least improve to low single digit to mid-single digit. Two-wheeler aftermarket growth has been steady, especially led by the scooter tire segment, to about high single digit to almost double digit. Rural market is shaping up well in two-wheeler. So that's the outlook in terms of demand in aftermarket.
So you're confident of double-digit growth that you have been targeting? And
we would definitely like to target double-digit growth because that's been the momentum for the first 3 quarters.
And what would be the range that you would be looking for FY26?
At this moment, I would like to say we are definitely targeting double-digit growth. So let's make it happen. Yeah.
No, from sales, if I can talk about the margin, because in the last conversation that we had with you, you had told that this year margin can be slightly below the last year that you had done.
FY25.
Correct. So if you can talk about the range that you might be seeing looking at for FY25, and also if you can say for FY26, what would be the range that you would be targeting?
Yeah, we normally don't give a guidance on margin. So you have seen in the last 3 quarters, it's been around 12 to progressively down to 10.4. I can share with you that the raw material situation looks flattish. So it has stopped escalating or increasing further. That's a good news. But it has not yet slackened or dropped off. So quarter 4, quarter 1, quarter 3, all will be similar in terms of raw material prices. What that means is that there will be perhaps no erosion of margins. And if we are able to take some price increases, they might accrue to the bottom line. Having said that, this is the busy season for tire trade, so competitive pressures will also be high. How much of that margin we can retain in our quest for market share, we'll have to see. But we are inclined to take some more price hikes in small doses much more frequently over the next 3-4 months.
I was coming to raw material prices. So natural rubber, and both if you can talk about natural and synthetic. So what is the range of rubber prices that normally you are comfortable with? And any price, obviously you are saying that you will be taking price hike, obviously it might be some small, but in the last 1 or 2 months, have you taken any price hike? So first, range of that you would be comfortable with, and price hike that if you have taken.
I would share the range of gross margin that we are comfortable with, because we really don't control the natural rubber prices, right? So we are, the least that we are comfortable with is about 40-41% gross margin. We are now about 5% behind that. So to that extent, we need to correct the gross margin. Of course, we are also looking at zero-based approach to the cost structure. So there will be some impact on the cost side as well. But gross margin, there is a clear scope of improvement by about 5%, which will be done through progressive price hikes of small amounts. We have taken some price hikes by the end of Q3, by January end, and we expect to take some more price hikes by end of March, and this approach will continue over Q1.
So do you mean to say that like rubber price, whatever is the current rubber price, still it's not at the comfortable range that you would say?
It has settled down at a much higher level than last year, is the reality, right? And there's a supply-demand gap in natural rubber. So it also depends on how the demand situation evolves. Sorry. So demand situation globally, not only India, but US, Europe, and the Chinese market.
So now coming to export front, because that segment also forms around 20% to your revenue. Now considering all these ongoing geopolitical issues and tariff tantrums, how is the order book looking at on the global front?
See, international business is something which is strategic for us, and we have invested in product development and nurturing in Europe, Latin America, and US. We've just launched in US. So it's important, however, it's also most uncertain. But the good thing is that our bets are placed over 3 geographies. Also, Middle East is pretty strong for us. So not everything goes down or goes up together. So we are able to hedge our bets a little bit. Freight rates are coming down. Currency depreciation is good news for international business. So these are the silver linings, I would say. We are getting good market access in Europe. We are looking at growing on a small base in US. So optically, the growth will be good. There are some headwinds in Latin America because of protectionist measures. So it's really a mixed bag. And if you're referring to US tariff situation, any increase in tariff has a negative impact on the prospect. But since our base is very small, the material impact, at least in FY26, will not be much.
So in Europe, you're saying that things have improved in the last few months?
For us.
For you? Yeah.
Yes.
Okay.
Yes.
All right, so that's SIA talking about their strategy ahead as they roll out that new range of tyres. We'll take a break on that note, come back on the other side, and we'll connect with Ravi Kapoor of PwC India, as well as Sachin Dikshit of JM Financial Institutional Securities. PwC has come out with a new report on what the rise of quick commerce means on traditional retail. And of course, we'll ask Sachin for some stock ideas as well.
Welcome back. You're watching us here on Corporate Radar, and what a move we've seen on the markets itself. 115 points on the Nifty, though the mid-cap index has given up some of the gains. And the reason why we've seen that is because, we've seen some sell-off take place in the wires space, which is accelerating. KEI Industries down 10% right now. Polycab down about 7% as well. Havells continues to see cuts of almost, 4 to 5%. CAMS, we just spoke with the management, that stock too is lower by about 2.5%. So maybe some bit of profit taking, maybe some bit of caution. And we are also seeing the Nifty bank face some resistance at that 50,000 mark. The Nifty is holding up because the IT pack continues to do well in today's trading session from its opening levels as well. But let's talk retail. A recent PwC report says quick commerce in India expanded at a growth rate of 73% in FY24. But was that on account of taking share away from traditional retailers, or was that organic growth from all the consumption spaces itself, is the big question. We have Ravi Kapoor, who joins in from PwC, and we also have Sachin Dixit, who's the lead internet research analyst at JM Financial. Thanks a lot, gentlemen, for joining in. Ravi, three things that really stood out for me from the report that you said. 60% of the traditional retailers perceive online shopping as a significant threat. The second part is that while e-commerce is likely to grow 22.5% over the next 5 years, traditional retail is likely to grow sub 8%. So, I mean, what are we looking at in terms of the overall pie expanding, or is it just channel shifting which is taking place? And in light of that, how do you view company strategies?
Well, thanks, Mangalam, for this opportunity. I think the prognosis is very clear. If you really look at the overall personal consumption expenditure in the country, it is growing at roughly around 7 to 8%. So clearly, there is a shift which is happening from our traditional channel mixes going into the organized channels in general, if I call them that, which is a combination of organized brick and mortar as well as the quick commerce and the overall digital commerce players. So clearly there is a move which is playing out in this shift. And what we are seeing here is that, like everything else, it's not evenly spread out. You cannot average out, or you cannot create a macro picture out of this trend. What we are trying to say here is that the way it is playing out for smaller traditional retailers in tier 1 markets, sitting in high SEC localities, the playout is going to be very, very different from when you look at retailers which are operating in tier 2, 3 markets, or bigger retailers where they are much more secure in the way they are able to manage this trend of e-commerce becoming bigger for them. So the hand is not evenly played out. There are pockets where we see this to be much more severe. And what it essentially means for brands is that you need to now take care of more dynamism, more complexity in the way you're looking at your channels. Clearly, we see as the overall growth story of India plays out, we see the organized channels becoming bigger. In fact, our sense is that in the next 5 to 6 years, organized channels should become 30% of the roughly 1.8 trillion retail market that we believe India will become. So clearly, something has to give. And clearly what we see is that the bottom of the pyramid is where the maximum amount of challenge is going to be for kiranas. And there are ways in which kiranas will have to really reinvent their business model. And that is what we have tried to cover as to what one can do to really play this out.
Sure, but Ravi, got your point. And I guess that challenge is far more pronounced in urban centers, right? Which is where we're seeing a greater adoption of e-commerce and quick commerce. But back to that central point. So does the report, finally come to the conclusion that right now e-commerce, let's talk urban centers only, that right now e-commerce is not really growing the market. It's only distribution shifting from one channel to the other. Is that what your report is finally indicating?
So it is not exactly that as well, right? Because overall retail is growing in India. Overall retail consumption is growing. Our sense is growing anywhere between 9 to 10% year-on-year CAGR. So overall pie is expanding, but there's a disproportionate shift in certain sections of the consuming economy, which is being taken over by the e-commerce channels. That's the way to interpret it.
I think in that, gentlemen, morning, Prashant here. Ravi, in that report, you talk about the Jevons paradox, right? I think the last we heard that was from, I think, Satya Nadella two weeks back, and that paradox shot into fame. But interesting highlights, an interesting report, really. Let's bring in Sachin into the conversation as well. Sachin, good morning. So you heard Ravi, and what does this mean for from an investor point of view? I mean, names like Zomato and Swiggy have corrected quite a bit. Do these trends make these stocks interesting and compelling investment opportunities?
Yeah, sure. What is happening is that most of these stocks, right, Zomato, Swiggy being in the public markets, and then also some unlisted companies that are there, everyone is growing very, very well. And something that's corroborated by Ravi's report as well, the sense like a lot of growth is coming from e-commerce, where quick commerce is rising in overall mix. So a lot of that channel shift is happening. What we are also seeing is that it's not just channel shift that's happening here. There is also a factor of accessibility that comes into play, right? It came into play in e-commerce earlier. Now through quick commerce, you are seeing that when some of these quick commerce players are expanding into tier 2, tier 3 cities, a lot of the brands that were not present there, a lot of the brands that could not afford to build distribution in these areas are now able to access this customer base, and the customer is able to access those products. So that is also playing out. Yeah.
Yeah, Sachin, exactly on that point, Ravi's report, actually, I was going through some of the details, and the report also mentions exactly this, that the quick commerce players, they're finding the difficulty a little more challenging in tier 2, tier 3 as compared to urban centers. That's where they have to figure out inventory management, logistics costs. The market is a little more fragmented. It's not as easy or as homogeneous as, let's say, Mumbai or Delhi. And this is exactly where the store rollouts are happening, right? We remember what Blinkit said and what happened to Zomato at the end of the last quarter. I think it was last, when they said that they will be investing a lot more in the store rollout plan. So, given that reality and the whole profitability metrics, do you think that it's good to invest in the companies even as they themselves are still very much in an investing phase, specifically on quick commerce? Sachin?
So what is happening in quick commerce is that you are seeing that a lot of store rollouts are happening. Companies have given guidance in terms of where they want to reach in terms of their store presence. But what is also interesting is that the store rollouts in tier 2, tier 3 cities are very minimal, in the sense like if you look at number of stores per tier 2 or tier 3 cities, that number is probably 10-20% the number of stores that you have in tier 1 cities. So what these companies are doing is that they are looking for basically micro markets in these smaller tier cities, opening stores there. And because quick commerce anyways is a densification play. So that's why that's the approach that they are going to take. And which is why when you look from Ravi's reports perspective, where he might be looking at a broader offline retailer perspective in these smaller tier cities, most of the retailers will not get impacted. It will be just that smaller,
Right. Sachin, what we understand so far from the way any market develops, first is curiosity, then there is denial, then there is, overwhelm, and then there is overestimation. In the Q-commerce opportunity, where are we? Because earlier there was, curiosity whether people want stuff in 10 minutes or not. Then there was denial that, maybe they don't want so many things. Then there was overwhelming stuff that, people are ordering fridges and air conditioners as well. At what point do we lead to overestimation of the market opportunity here?
So some of the overestimation, I'll say, has already corrected, right? If you look at how some of the reports came out in the past 1 year, there were a lot of ambition that was built into quick commerce, thanks to the fact that a lot of players have entered, a lot of profitability guidances have been toned down. So I think we are now, after overestimation, I think that overestimation did happen at some point. We are now reverting back to the norm where the valuations look saner, the estimations look more in line. But still, even today, I think a lot of uncertainty still prevails in this sector because there are still players who are trying to enter and try to make a dent to the quick commerce landscape. At one point of time, there was only Swiggy, Zomato, and Zepto who were trying to do anything here. Now we are talking about 3-4 players who are trying to make a proper dedicated quick commerce play. Secondly, we are also seeing a lot of the marketplaces in terms of the e-commerce side who are now moving to a 2-hour, 3-hour delivery, right? Which again tries to play into that quick commerce arena. So I think in that sense, a lot of turbulence is still there, and which is why you have seen the corrections that have happened. Now the bet is like whether you want to play this sector in the sense like look for who is going to be the winner and try to back them up, or you want to stay away from it. So I think we are still seeing some divergence there. Obviously, people are putting their chips on some of the players, which you can see how the stocks have been moving around. But I think the uncertainty level is certainly higher than what we have seen in the
Uncertainty level is certainly high. That is why we got you, Sachin. So from a viewer's standpoint, those who are looking at Zomato and Swiggy, what should they do?
So obviously, in terms of where the valuations are, we have very strong ratings on both the stocks. We have buy ratings on both the names. Right, Swiggy's quick commerce play is slightly behind what is there for Zomato, which is why you are seeing that Zomato has picked up in the last few days, and we are seeing Swiggy also remaining. I mean, at least the bottom seems to be capped as of now. But we do have buy rating on both the names, and we believe that quick commerce in this format is going to sustain. There is certainly an market adoption, a customer love that we have seen for the model. So in that sense, I think the story is long enough to be played for some more time.
All right, we'll leave it there, gentlemen. Thank you very much for joining us and speaking to us about what you see as trends here in the space. And we continue this conversation because, of course, I mean, there's a lot happening, newer entrants as well in quick commerce, which we've not touched upon. So people want a piece of the pie, which is expanding. Sachin and Ravi, thank you again. Well, while we've been on that discussion, markets have seen a fair bit of move. So not so much on the Nifty, but the mid-cap index, look at the intraday mid-cap index, the intraday small-cap index. We've completely given up gains. From yesterday's close to the day's high, the gain was about 1%. We've given back about 1%, from the day's high. I mean, basically the high in the last 45 minutes that we've been trading or so. So it's a pretty steep come down. On the Nifty, you still have 23,000, about 100 odd points higher. And I have to say, even as that's happened for mid and small cap indices, market breadth is still very strong. I mean, I think it's almost close to 3:1. It was 10:1. It's about 3:1. So we'll see and track how this progresses from here. That's a Nifty heat map as well. Mitesh is back with us. Mitesh, morning again. Just a quick view on indices and, of course, what's happening in broader space.
So, morning, Prashant. I think the view remains positive. And as I said, after 2-3 days of nearly 2.5 days of good rally, you might get an intraday dip. But I think for me, that would be a buying opportunity. So still, the Nifty has hardly declined from the highs, only about 30-40 points. The Bank Nifty has tapered off a bit by about 200-250 odd points. But I think the chart structure remains positive. So I'll maintain 50,500 as the near-term target for Bank Nifty. And once we clear 23,150, then 23,500 as the target for the Nifty. Very, very clearly a long bias. And in case we get another 80 to 100 point dip on Bank Nifty, I would even want to add on to long positions.
Couple of heavyweights doing well right now. That should aid your call as well, Mitesh. We have Reliance, which has moved to the high point of trade swiftly. And we have HDFC Bank, which saw a dip, and from the lows, that stock has moved higher as well. So just look at Reliance. That may support the cause of the index a little more. And HDFC Bank, which saw a bit of a dip, and that dip too has been bought into. So with that, what we'll do is take a short break. Actually, Mitesh, you have stock picks as well at 10?
Reliance is in fact one of the picks,
Okay.
Very good structure coming out of a good correction. There's a fresh buy with a stop at about 1245 for targets of 1290 to about 1300. And the other one which I like is a tech stock. In fact, technology is trying to show signs of recovery. So Tata Elxsi is something which has come on the radar. Slowly buy here with a stop below 53.85 and look for a target of around 55-52 billion.
All right, Mitesh, thank you so much for joining in and giving us your calls. With that, we'll simply do a short break, come back on the commodity space. Manisha Gupta gives us a wrap on all things that are moving.
Welcome back. Well, the equity market got a little wobbly on the mid-cap index. Let's actually see the Nifty as well. A quick, taking stocks. Nifty is fine. It's the mid-caps where we got a bit of a sell-off. Let's take a look at now what's happening in commodities. We have Manisha joining in. Manisha, what are you tracking this morning?
Well, I'm looking at overall metal as a sector. I mean, we've all been talking about on how gold is trading at an all-time highs, but within the metal space as well, what is really giving tough competition to gold has been the copper prices. Very strong gains onto that one. Let's talk about the macro first, and the US Fed projected slow growth and higher inflation, and we've seen some bit of a buying come into tangible commodities because of that. And then apart from that, there also have been statements from Powell saying that they're not in a hurry to adjust borrowing cost yet, but also said that they are waiting for greater clarity here, but also said that the US Fed could be looking at 0.5% of an increase in interest rates by the end of this year. But let's take a look at copper right now. And even as these statements were coming in, you saw the copper prices gain up by more than a percentage point. So when you look at week-on-week basis, we've seen copper prices gain up by 4%. It's up 13% in last 1 month. And in this year until now, we have gained by 28% for the copper prices. So very strong gains. This is more than what gold has done, more than what silver has done, and more than what various other commodities also have performed in this year until now. So when you look at the spot markets, we have seen that reflect supply tightness. That is because there's a lot of buying happening on LME in Europe and especially in the US markets there. Inventories on LME and Shanghai have continued to see a decline, and the only one place that you have seen inventories actually gain up has been the US markets there. China's special action boost that we saw come in on Sunday also has led to a lot of sentiment buying. The consumer spending in China is expected to gain up with the kind of stimulus measures China is putting out, and that in turn also has been supportive. But you really need to see on what US is doing when it comes to copper. So we are hearing this for last month now, that US could potentially impose tariffs on imports when it comes to copper. Now, US imports nearly 45% of its copper demand, and US copper at this point in time is trading with $1,200 a ton of a premium to anywhere in the world. So US copper is expensive at this point in time. Also, when you look at the US copper imports, they are near all-time highs. So the all-time high that we've seen in sense of imports in any month in US has been 132,000 tons. But there are reports that Trafigura, Glencore, Gunvor Group are redirecting a lot of copper to US from Asian and UK markets there. So that clearly has been supportive. Also, there are expectations that in this month, 100,000 to 150,000 tons of refined copper is being shipped to US. And that is what is commanding premium. That is what is taking the prices on the higher side as well. The markets do believe that we are trading very close to all-time highs when it comes to copper. And if these numbers continue in sense of copper being shipped into US, you could be looking at all-time highs not too far away in sense of copper.
All right. Thank you very much, Manisha, for that. So that's metals and copper in focus. Well, copper essentially is what we are talking about next, but in the form of cables and wires. Stocks are taking it on the chin. One more entrant, large conglomerate making an entry. Vinny's here with a focus on that. Vinny, morning.
Morning. So absolutely, we're seeing a bit of a pressure coming in on all these cable and wire stocks, KEI cables, or even Polycab, Phenolux cables, RR Kabel, all of them under pressure today. Now, increasing competition is the key factor for this. Adani Enterprises has formed the JV for its cables and wires segment, where we're seeing that the 100% subsidiary of Adani Enterprises, that is Kutch Copper, has formed this 50-50 JV with Pranita Ventures, and this is going to be called Pranita Eco Cables. Now, what is this business that is going to be from this JV? It is going to engage in the business of manufacturing, marketing, distribution, buying and selling of metal products, cables and wires as well. So this is very interesting. Now, as of now, what we know, we don't have the details of the exact investment that is happening, but Kutch Copper Limited last year had spoken about, in 2024 sometime, they'd spoken about investing $1.2 billion to set up a 1 million ton per annum copper plant in Mundra. So this is still underway. This is still under development and construction, and that would be making products like copper rods, gold, silver and other copper products. So this is going to be interesting of how Adani Enterprises is going to play out with this and Kutch Copper Limited in terms of what is the exact business that they'll be doing, since it's a 50-50 JV. Nonetheless, just in the month of Feb, we had Ultratech Cement also, who had announced that foray into cables and wires, making that capex plan announcement of around 1,800 crores over the next 2 years. And since then, we've seen all these stocks be under pressure. In the last 1 month, we've seen the stocks fall almost in the range of 10 to 19% for all these stocks. So keep an eye out on that. Pressure surely is increasing. And analysts are saying that this could maybe hurt the industry better, and some bit of the return ratios for these incumbents may get impacted as well.
Sharp fall. Look at that, 12 to 13% down on some of these names like KEI now. Vinny, thank you very much for that perspective. We do have to take a break on that note. Come back on the other side and it'll be time for our special segment. It's the economy. Lata, today we'll discuss Asia macros and markets post the Fed decision with Louis Kujus of S&P Global Ratings and Neeraj Seth of BlackRock.